One company spends $60 billion a year on computing power. It earns $13 billion. That math is holding up the entire market. By one macroeconomic measure, the AI boom is now 17 times larger than the dot-com bubble and 4 times the housing bubble. $19 trillion of market value is running ahead of any measurable economic impact. That is Goldman Sachs' number, not a blogger's. And yet the money keeps flowing, faster every quarter. Which raises the only question that matters. What exactly is holding this up? The answer is a machine. A financial machine, built from 3 parts: debt, hidden obligations, and a loop almost nobody talks about. Let's take it apart, piece by piece, because when you see how it works, you also see exactly where it can break. Part 1. Debt. In just 5 months, the biggest tech companies issued $159 billion in corporate bonds. Amazon, Alphabet, Meta, Microsoft, Oracle, companies famous for mountains of cash, are now borrowing to build data centers. Amazon's capital spending hit $151 billion in 12 months. That is more than its entire operating cash flow. Free cash, negative. And the visible numbers understated. Moody's found $662 billion in signed data center leases that sit off the balance sheets. That hidden obligation is larger than all the on-balance sheet debt of those same companies combined. The clean, self-funded story doesn't survive it. Here is the twist that makes it dangerous. The chips inside those data centers live 2 to 3 years. The debt lives far longer. Part 2. The loop. Follow the money and it goes in a circle. The same dollars counted as investment, then revenue, then proof. Nvidia, valued at $5 trillion, invests $100 billion in OpenAI, which spends it on data centers full of Nvidia chips. Microsoft owns 27% of OpenAI and provides nearly a fifth of Nvidia's revenue. Every player holds a piece of every other player. When CoreWeave borrows billions to build capacity, Nvidia guarantees it will buy whatever capacity goes unsold, all the way through 2032. Rising valuations justify heavier spending. Heavier spending signals explosive demand. The signal pushes valuations higher. Around and around it goes. Analysts call it a closed, recursive financing loop. A loop like this doesn't break slowly. It breaks the moment revenue fails to arrive on time. So, is the revenue arriving? Surveys keep finding that roughly 95% of corporate AI projects show no measurable return at all. Despite hundreds of billions spent since 2022, analysts still cannot find a measurable AI effect in U.S. economic growth. The physical build-out is slipping too. 60% of data center capacity planned for 2027 has not even broken ground. The Federal Reserve now formally lists artificial intelligence as a top systemic risk to the financial system. Regulators are watching. Goldman Sachs counts 5 danger signals straight out of the 1990s. Peaking investment, falling profits, rising debt, rate cuts, widening credit spreads. None of this means the technology is fake. It means the market has already paid for a future that has not shown up yet. There is a real bull case. AI chips are sold out 18 to 24 months ahead. That is hard demand, not hype. And history offers a strange comfort. The telecom bubble of the 90s burst brutally, but the fiber it built powered the internet age. The likeliest ending is not a crash, but a rolling reset, like 2000 to 2002. The weakest fail first and drag others down. Remember, when the dot-com bubble finally burst, the Nasdaq lost almost 80% before the selling stopped. Bubbles overshoot in both directions. The technology is real. The infrastructure will outlive the panic. The only question is, who is still standing when the bill arrives?